Now let's look at exercise 2-5. It's on page 102 of your text. And here we're going to go through some more journal entries. So it says Texas sales consultants completed the following transactions during the later part of January. So on January 22nd, it said performed services for customers on account. So here's that on account again. We've provided a service and we haven't gotten paid yet. So that's accounts receivable. All right, and we're going to go ahead and record the service revenue. And this would be performed services for customers on account. All right, now we get to January 30th. It said received cash on account from customers of $7,000. So we received the cash for that receivable now. So it says received cash on account from customers. So they're paying us for their account. So that means our cash is going to go up. And we're going to reduce what they owe us. So we're going to reduce that accounts receivable because now they don't owe us that money anymore. We've actually collected it. Okay. And our description would be received cash on account from customers. Okay. Then January 31st, it said received a utility bill, $180, which will be paid during February. So this is an example of where we've incurred costs. We've used up whatever the utility is, whether it's water, electricity, or anything. We've used it up, so we have a cost, and we haven't paid it yet. So anytime we have some kind of cost where we've purchased something or used something up, and we haven't paid it yet, that creates a liability. So we're going to have a liability that we owe of $180. Now, since it was a utility, we're going to have utility expense because we've used it up in generating revenue. It's an expense of $180, and we're going to have accounts payable because we're going to pay it later. Now, this accounts payable, we can go ahead and we'll identify it as utility payable. Okay, we can be specific because we know exactly what it is. And we'll put on our description, receive a utility bill due in February. All right. Then the next thing on January 31st is we paid monthly salary to a salesman. So we're paying money out. That means our cash is going to decrease. And when we decrease cash, we decrease it with a credit. And then it's salary. Okay, paying salaries to our employees is an expense. So we're going to have salaries expense of $2,000. And this is us paid monthly salary to salesmen. All right. Okay. The next transaction that happened on January 31st was we received $1,500 for 3 months of consulting services to be performed starting in February. So we've actually received the cash. We're going to increase our cash with a debit, $1,500. But it says it's for services we're going to perform later. So we're not going to perform any services till next month. So this is what we call unearned revenue. This is when we receive cash in advance for services or a product that we're going to provide or perform later. So that's a liability. So to increase this unearned revenue account, this liability account, we credit it $1,500. Okay. We see 3 months consulting services in advance. That would be our little description. We received 3 months of consulting services in advance. The last transaction, it says the owner, Dylan Hanson, withdrew $1,000 from the business. Okay, so he's withdrawing $1,000, not 100, 1,000. So we're going to have withdrawals. If you remember, that's an equity account, but it decreases equity. So we increase our withdrawals account with a debit. So $1,000 debit to Hanson withdrawals. And of course, we're giving him cash, so we're going to credit cash for $1,000. Okay. And this was an owner withdrawal of cash. All right. So that's all of the transactions for this problem. If you have any questions on this one or exercise 4, make sure to post your questions to the Chapter 2 questions discussion board in D2L.